every investor must know. What if I told you that you don't need Wall Street secrets, complicated models, or finance and business degrees from top notch universities to know about whether a stock is cheap or expensive? In fact, with just six simple formulas or ratios, you can quickly spot overvalued stocks, undervalued stocks, and avoid the biggest beginner mistake. By the end of this video, you will know exactly what numbers to look at, how to calculate them, and most importantly, how to use them to make smarter investment decisions. Today, I will walk you through six essential stock valuation ratios that investors use to evaluate a company's value, profitability, and growth, step by step with simple explanation using PAA values as an example. Price to earning ratio tells you how much investors are willing to pay for $1 of company's earning. So in order to calculate that, we need to find out share price and divide that with earning per share. That's so simple, giving us PE ratio. If a stock trades at $50 and earns $5 per share, the PE ratio is 10. That means investors are paying 10 times the company's annual earning. So high PE ratio either means it's an overvalued stock or it's a growth stock. And the growth stocks decision we should actually combine with other readings to find out it's a good one or not. Low PE ratio means it's undervalued or value stock. Again, in order to find out it's a value stock, we need to read this with other calculations as well. So let's take an example of calculation from real values, which we were discussing about PAA. So the formula is stock price beta EPS. The stock price was $19.20 and earning per share was $1.03. So the PE ratio is $18.64. So any PE earning per share. Earning per share shows how much profit a company generates per share of stock. Earning per share is net earning divided by outstanding share. So higher earning per share means higher profitability and lower earning per share means lower profitability. Investors usually care deeply about EPS growth because stock policies follow earnings over time. No earning, no valuation. Let's take a quick example from PAA. Actual values, net income divided by outstanding shares. So the net income was 1.338 billion divided by 0.0686 billion. Earning per share is $1.95. Good earning per share is greater than 10% compound aggregated growth. PEG ratio. What is PEG? The PEG ratio improves the PE ratio by factoring in earnings growth. So the formula would be PE value or PE ratio divided by earning growth rate. High PEG means undervalued and low PEG means overvalued. Let's take an example from real stock values of PAA. So PEG is PA ratio but a earning growth rate. So we already calculated PE ratio was $18.64 and 65.8 was is earning growth rate. So PEG ratio will come 1.94. PEG from 1 to 1.5 is fairly valued, and 1.5 to 2.0 either it's growth, fully priced, or expensive. And PEG less than 1.0 is undervalued. Return on equity, ROE. What is ROE? It measures how efficiently a company uses shareholders' money to generate profit. It's very, very important when you are going to invest. ROE mean the formula for that calculation is net income divided by shareholders' equity. Higher ROE means higher profitability, lower ROE means lower profitability. Let's take examples from real stock values of PAA. As we know the formula, we put in net income of 500 million divided by equity of 5 billion. The result is 10%. Good return on equity is larger than 15%. So higher ROE, better management efficiency, and consistently if ROE is higher than 50% is generally strong. But be careful. Very high ROE can be inflated by high debt. Strong profitability and efficient capital use is actually in this example. Return on invested capital. What is return on invested capital tells you is how efficiently a company turns invested capital into profits. For every dollar invested in the business, how much profit is generated? That's actually briefly we can this ROIC is telling us. So what's the formula to calculate it? Net operating profit after tax divided by invested capital. So we already know operating profit minus taxes is NOPAT, net operating profit after taxes, and invested capital is total debt plus equity. Let's take an example from the real values of PAA. If we factor in 1,163 million divided by 22,829 million, so ROIC is 5.01%. Good ROIC is greater than 15%. 15%. So ROIC less than 8% is weak or value destroying. ROIC between 8 to 12% is average, and ROIC higher than 12 to 15% is good. ROIC greater than 20% is excellent or more business. Gross margin. Gross margin is revenue minus cost of goods divided by revenue. Higher margin means higher profitability, lower margin means lower profitability. So let's take an example of gross margin from PAA real values. Gross margin is gross profit divided by revenue. So 3.3 billion divided by 46.92 billion, 6.666%. Good gross margin is above 40%. But it varies in each industry. For example, Walmart's the grocery stores, their gross margins ranges between 10 to 25%. But some tech companies, their margin is higher than 50%, like Microsoft 69, and even Adobe sometimes touch 89%. EBIT margin are earning before interest and tax. That actually tell us this is a measures operating efficiency before interest taxes. The formula is EBIT margin is EBIT divided by revenue multiplied by 100. Higher margin means more profitability, lower margin means lower profitability. So let's calculate EBIT margin from the real values of a PAA stock. EBIT margin is EBIT divided by revenue multiplied by 100. It comes to 2.60. Good EBIT margin is above 10%. So let's say if it was 10%, this means the company turns 10 cents for every dollar into a profit before tax and interest and taxes. 2.60 is very, very low. Common beginner mistakes. Using only one ratio. All the ratios should be combined together and read together to understand the stock value. Second is ignoring industry comparison. You can't compare IT stocks with grocery stocks. Those Each stock should be compared with the same industry because everyone have different values. Then chasing low PE without no growth or without zero growth or less growth. The last one is ignoring debt values. So valuation is about balance, not shortcuts. So finally, let's recap the six ratios, what they are telling us. PE value, what you pay for earning. EPS, profit per share. ROIC, turning capital into profit. ROE, management efficiency. PEG, growth adjusted valuation. Margin, that tell us about business strength. Used together, these ratios help you invest smarter, not harder. Price is what you pay, value is what you get. What stock should we value next? Please comment the ticker of that stock in the comment section. If you like my video, please like and subscribe. Thank you for watching.